But joining us for a little bit more on some of the markets, and we might check in on some of the commodity price moves too, with Larry Shover from Efficient Capital Management, also author of Trading Options in Turbulent Markets, joining us live from the CME Group in Chicago. Give us some thoughts, Larry, just to kick off, about what people are saying is very narrow trading range, and also the fact there seems to be a bit of complacency in the market. We've been noticing that VIX index down at 16.
You know, the equity markets are stuck in a range, you're right, but we keep grinding higher. The very important number last week in the S&P was 1245, 1248. We're above that. The S&P hasn't had two consecutive down days in a row all month of December. It's just unbelievable. Next stop seems to be 1265 and 1280. People don't seem to be worried about the sovereign debt issue in Europe. Even though Moody's has downgraded Portugal, and we have the latest news from Fitch's, the market seems to be very, very comfortable with the inflation monetary policy of China. And we're happy with our economic data coming out. We're making baby steps. Most of our earnings are out better. The market's grinding higher. I would not sell a dull market short right now.
Okay, so because some people have said this market looks a little overbought, there's almost too much bullishness around.
Yeah.
Even just this month, you've seen the S&P 500 index up 5%. You don't think that will correct?
Yeah, I mean, I think it'll correct early in January, but it might be a technical correction. The fact of the matter is that the bullish sentiment is higher now than it's been since the Lehman crisis a couple of years back. That's not to say that this bullish sentiment can't continue forever, or not forever, but for an extended period of time. With that said, we could definitely see a drawback down to 1,200 in the S&Ps. But given the forecast of earnings for S&P 500 stocks, even the most conservative estimates are saying a 15% growth rate for the S&P 500. I can't see us breaking much below 1,200, given some type of outlier event that would happen to occur.
Larry, Alpha Litton here, Allianz Markets. Let's talk bullish sentiment, your classic bullish risk on trade. Oil up above 90. We spoke a month or two ago and we were saying it's not a matter of if, but when oil would get above $100 a barrel. Now we're really looking at, is that going to be curbing consumer spending in the US? One of the key reasons why the Fed injected this QE2 and excess liquidity. Do you think that this rising oil price is therefore going to hamper the positive effects of this excess liquidity?
Yeah, you know, the consensus says that we can handle oil at $100, $110 a barrel. Much beyond that, it's going to hamper economic growth per se. But it won't hamper the S&P 500 or the general equity market, which is fine with higher oil prices. But to the average consumer, with our increasing debt problem, with our unemployment rate, oil above $110 a barrel could be a problem. But a lot of technicians see a sell point there at 110.
Right, and with that consumer as well, there, Larry, obviously we are seeing oil up above the 110, 70% of the GDP from that consumption side. You touched on the unemployment rate, and we've spoken to all of our guests from the US today about that. That rate just can't get any lower. What is going to be the real catalyst there? What do the governing bodies need to do to get that down?
Well, what they need to do, what they probably won't do, is cut spending. We need to do something to further economic activity in the country. Obama and the Republicans came to an agreement last week to extend the Bush-era tax cuts. That's definitely going to help with the economy, but they need to go further and cut spending. Our debt is strangling us, and right now, companies will not hire new people, even though they're doing well with all the regulation out there, all the unknowns out there. We need to cut spending, make our government smaller, make it work properly. Therefore, I think the economy will work as well, and we'll see unemployment rates go lower. But we have to keep in mind also that last week they extended unemployment benefits for another year, and that's going to keep the unemployment rate artificially high for those who have spouses at work, for those who really just don't want to go out and get a job. It's going to keep our rate a little bit higher than it probably is. I think the unemployment rate will go lower next year, although not as low as it probably could given the artificial hike in unemployment benefits.
And what about the role of the Federal Reserve through 2011 in terms of the effect on sentiment? We know that the buying as part of QE2, that kind of winds up mid-year. When I speak to a lot of people, I get the sense everyone feels like they can anticipate what will happen up to mid-year, but then it's kind of all the question marks get raised once that gets pulled away.
Yeah, that's a really interesting point. And the fact is, I think the Treasury market right now is very indicative of what you just said, is that it's moving sideways with no rhyme or reason. QE2 will be running out by the end of the year, and some people think that there's going to have to be a QE3. It all depends on what happens to interest rates, the unemployment rate between now and next April. It seems to me that Bernanke has done a wonderful job so far, and it is working. We are making baby steps, but it's a long time between now and April with all the government reports that have to come out. And the fact is, the Fed's going to be running out of bullets. What's QE3 going to look like? How much bigger can the federal balance sheet get? I mean, it's going to be well above it's ever been in April, and then they're going to increase to that. That has problems as well.
Larry, Al here, I think you just touched on it then, the Fed balance sheet. Look, how long can this go for? QE3, QE4? We're looking at Europe, and yes, we're seeing Moody's downgrading some of the companies there, but it's fair to say that they're actually trying to get their balance sheets in order. They're trying to get the debt under control there, whereas from the US's point of view, it's simply a matter of adding more and more debt to this balance sheet. I mean, how long can this go for, and when we'll have to sit back and do what Europe are doing and enter austerity measures and say, OK, we need to get our balance sheet in order?
Yeah, we have to do that right away because, we have 5 states in America who could easily go bankrupt in 2011. I think there's this false notion that Ben Bernanke is going to bail out any state that has an IOU that they can't pay. Pennsylvania just had one that they bailed out Harrisburg just a couple of weeks ago. It's going to come to a point, though, where you have California, New York, New Jersey, Illinois. They won't be able to pay their IOUs, and the government will not have the wherewithal to lend that money. I think Europe actually is doing a much better job, a more proactive job at this, and especially with Germany and France. They have their house in order compared to the United States, and that's the one big outlier that could affect our markets in a big way midway next year.
Larry Shover, we're about to drop the satellite line, unfortunately, so we will have to thank you very much, and we'll chat to you soon, hopefully. Thank you.